Good afternoon, everyone, and welcome to our halftime market insights video. Today, on our webinar, we would like to share results of what happened during the first 6 months of the year, as well as what to watch for the remainder of the year. Now, before introductions, the usual housekeeping items. You can submit a question at any time using our Q&A feature. Please submit anything that's on your mind or anything we discussed today. We'd like to maximize the hour you spend with us today, so please let us know how we can help. Second, this will be recorded and uploaded to our YouTube channel. You can go back and watch it at a later time or share with your colleagues. Now for introductions. For those of you who have joined us on previous webinars, most of these names and faces should look familiar. I'm Greg Leonberger. I'm the Director of Research here. I will host this afternoon's webinar and also discuss the real assets section. Jessica Naviscus will cover the U.S. economy. Frank Valley will cover fixed income. Catherine Hillier and Evan Fraser will discuss U.S. equities and non-U.S. equities, respectively. For the alternative section of this afternoon's webinar, Chad Schaefer will cover hedge funds, Haley McCollum will discuss private equity, and Brett Graffi will finish the session by discussing private credit. We have about 45 minutes of prepared remarks. We have 15 minutes to the end to answer any questions you have, so I really can't stress enough. Please ask anything that's on your mind. We like to lead with the U.S. economy. That's the backdrop to capital markets. There's a lot to talk about between inflation, Fed rate policy, as well as growth expectations. Jessica, take it away.
Thanks, Greg. So I am aware that I'm starting to sound a bit like a broken record on these webinars, but inflation is still really at the center of the macro story. Our last data point here was June CPI that came out earlier this month. The headline number was 3% year over year. That's the lowest we've seen since April of 2021. The primary driver of the correction in headline has been energy. So back at the peak last June, energy contributed 300 basis points of the 9.1% CPI reading. This June, on a year-over-year basis, energy was actually deflationary by 150 basis points. So that's a 450 basis point swing. That's accounted for about 70% of the correction we've seen in headline CPI. The bigger news, though, in June was that core inflation slowed. So core excludes food and energy prices, and that came in at 4.8%. That was better than expected and a really positive step after core has been sort of stuck in that mid 5% range since the end of last year. Shelter is the biggest component of core. It's been one of the stickier parts of inflation. That was still up month over month, but it is slowing. And shelter is a lagged metric. So the hope here is that we continue to see this contraction in core as the rent declines that we saw at the end of last year continue to flow through the calculation. Then the other big piece of the macro picture is the employment market. So we all know a strong labor market is good for an economy, but when it is too strong, which is more so where we've been, it leads to outsized wage growth, and then that feeds into inflation. So monthly employment numbers are typically pretty choppy. We've seen some bigger revisions, so we don't want to put too much weight into these numbers, but there have been some more confirming data points recently that show that we're seeing some of this needed slowdown. So on the chart on the left, job ads ticked down in June, that last column there, though again, off of a higher number in May, that data moves around a bit. In the same chart in the green, unemployment has moved up slightly off the lows. And then job openings, so that's not shown here, but again, have been moving kind of overall choppy, but in the right direction. Then the sort of ultimate metric here is wage growth. So that is shown on the chart on the right. And again, generally moving in the right direction, but still too high to be consistent with 2% inflation. And that's especially true given some of the weaker productivity numbers that we've seen lately. And then on top of all of this, again, not on this slide, but labor participation, which has been a pretty big focus since COVID, is generally back. So prime age workers, that's 25 to 54-year-olds, their labor participation levels are now back above pre-COVID levels. So that is good news in the sense that we have seen people return to work, but the flip side of that is that from here, it's potentially less of a lever. So there's not this supply of workers sitting on the sidelines that can re-enter the labor force and sort of solve this supply-demand imbalance for us. And then that could mean that there's more limited progress to be made on wages from here. And that could mean that those last few percentage points of inflation could be harder to get rid of. So that brings us to the Fed and rates. This has obviously been a pretty big driver of markets over the last really 2 years. So in the second quarter, 2 FOMC meetings. At the first in May, we got a 25 basis point rate hike, pretty broadly anticipated. And then in June, the pause, which was also anticipated. The kicker, though, in June was that the Fed releases a summary of economic predictions 4 times a year. That includes that dot plot that shows where FOMC participants expect rates to go from here, and kind of the median from that, where about half of FOMC members was 2 additional rate hikes yet this year. So the pause in June, but signaling that they're not done yet. The futures market is something we watch really closely. So that is what is shown on this slide here. It kind of shows us what the market is currently pricing in. And all year, the futures market has essentially been behind the Fed, expecting that they won't raise rates as much as they've implied and will cut earlier than they've implied. So this is still the case. After the June FOMC meeting, the market was pricing in just 1 additional 25 basis point hike. That's widely expected at the July meeting, which is next week. And then the market was expecting a pause through the rest of the year. That initially seemed a little bit bullish, but with this last CPI reading, core inflation slowing, if this continues to slow, that is probably the most plausible reason out there why the Fed would pause earlier than expected. Then the next layer to this is GDP. So overall, the economy has been generally more resilient than we would have expected. I think anyone would have expected coming into the year. The final estimate for Q1 GDP growth recently came in that put annualized growth at 2%, and that was revised up from the prior estimate of 1.3%. Bloomberg consensus is that we will still see a recession in the U.S. at some point in the next 12 months, that with that kind of annualized GDP growth continues to slow from here. We hit a low of just slightly negative growth in the fourth quarter, but at the same time, sort of outside of those official forecasts, talk of a soft landing is picking up again. And that's just on the progress we've seen on inflation without inflicting too much pain in the labor market. There are still the risks out there. So as we said, the last few percentage points of inflation could be tougher to get rid of. We could see less progress in labor markets, given where supply is now. And then credit conditions, which have not gotten much airtime lately, just given that kind of the regional banking issues have sort of faded into the background over the last few months. But that could have a bigger impact going forward. And sort of to that point, I think this consumer savings piece of it could be a much bigger factor over the next several months. So monetary policy always operates with a lag. We know that. That's what the Fed is trying to account for now. But this round of tightening in particular, it seems that the economy has just been less sensitive to it. Part of that is likely due to the amount of savings that consumers had built up during COVID. So with those savings, even as things got more expensive, real wages weren't quite keeping up with inflation, but consumers continued to spend. As a result of that spending, and that's what this chart shows, savings rates are now below long-term averages and credit card debt is up. And these are things that are just not sustainable in the long run. So based on kind of current estimates out there, the thought is that all this excess savings could be fully depleted by the fourth quarter, and that could leave the consumer in a pretty different spot. So higher rates and these tighter lending conditions may start to matter a bit more. So the main takeaway kind of for me is that things are definitely trending in the right direction. Markets are clearly anticipating that that continues, but we are not there yet. And with some of the moving pieces, it's not guaranteed that we will get there.
In Jessica, given that GDP is about 2/3 driven by consumption and personal expenditures, a big dip there could weigh heavily on future GDP and probably ultimately influence whether or not we're in a recession sometime next year. Thank you for that, Jessica. And then let's move now to the traditional asset classes. We start with fixed income. There's a pretty easy linkage between Fed policy and interest rate movements to what the fixed income markets do. So Frank, what do you see as having happened the first half of the year? And then what are you watching the second half of the year?
Sure. Thanks, Greg. So performance was mixed here in the second quarter of 2023. What we saw during the quarter was rates moved higher, but at the same time, spreads came in a little bit. So what we saw was rate-sensitive sectors were lower on higher yields. So the Bloomberg Ag was down 80 basis points. The long government bonds were down 2.3% Conversely, with the tighter credit spreads, more credit-sensitive sectors exhibited positive total returns. The high yield index was up 1.7%. Loans were up 3.1%, which were also helped by rising rates, and EM was up 2.2%. Year-to-date performance remains positive due to higher starting yields after the backup in 2022, flat rates year-to-date, and tighter spreads. So treasuries moved higher during the second quarter as the Fed expectations changed. Earlier in the year, the market expected the Fed to pause and then priced in aggressive rate cuts later this year. That sentiment has really shifted year to date to the point where the market was now expecting rates to increase through June, and then they had to skip, which they did, and now the market is fully anticipating another rate hike in July. As of today, the market's currently pricing in a 25 basis point rate hike next week. The continued Fed action this year has kept the curve inverted at historic rates. So when we look at the fixed income market more broadly, all-in yields are good. But unfortunately, most of this is due to elevated treasury yields. The treasuries are at a higher level than they've been in quite some time. And this has pushed the all-in yield significantly above historical average. However, when you look over at the other side of the page, when you look at spreads, most of these sectors are at historical levels and are nowhere near recessionary levels. Another way to look at it is to take a look at credit spreads versus historical averages. Right now, there's not a lot of value in spreads. High yield spreads are trading inside of historical averages, while investment grade spreads are trading right on historical averages. If you do see these rate hikes that the Fed has put into place, push the economy into recession, spreads will widen significantly to price in that recession because they're going to end up taking a lot more risk. But currently, there's not a lot of value in spreads. One area where there is a little bit of value is in the local EM market. So there is a significant pickup looking at local EM markets over developed rates. EM actually at this time has good fundamentals. I mean, what we saw in EM markets was they pretty aggressively hiked rates before developed markets, and now a lot of those markets are in position to start cutting rates. One important thing to note, though, when you do consider EM markets is you do have a lot of FX exposure, which could put some volatility into the asset class. However, local market should benefit from a weaker U.S. dollar, which is what you've seen this year, after last year, which the U.S. dollar was one of the strongest markets there was. So just to wrap up, looking at the opportunities and risks, this is a title that we've used quite a few times, and that's bonds are back. Last year's rate rises gave higher starting yields. Those yields still remain elevated today, and that's going to generate a lot of income for your portfolio. Those bonds also, because they do have higher yields, you could see the Fed come in and cut, which would give you that ballast in your portfolio. The second piece is the Fed is getting close to their terminal point. We've seen the Fed raise rates in 2022. That's continued in 2023, but it's at a lot slower pace. You may continue to see them inch higher over the coming months, but likely the next big move is down, which is good for fixed income investments. Conversely, the big risk is an economic downturn. If you do see an economic downturn, and this is particularly true in the spread sectors, spreads are nowhere near recessionary levels. If there is an economic downturn, you'll see spreads widen significantly on a slowdown.
And Frank, one of the things we've spent a lot of time talking about as a research team, as well as talking to our clients about, is that the absolute level of yield, as you alluded to earlier, is much higher than it was 12 to 18 months ago. So even if there is an unexpected greater rate increase, or if spreads blow out, that price compression you see from rate movement or spread movement should be more than offset by income levels given the overall level of yield. So all in all, a pretty good place for fixed income as we enter the second half of the year. Let's move over now to the equity side of things. And Catherine, tell us what you saw during the first half of the year and then what you're looking for the second half of the year.
Yeah, thanks, Greg. So strength in the domestic equity markets the first half of the year has been a bit surprising. In the second quarter, U.S. equity performance was characterized by the leadership of mega cap companies. This continued the trend established in the first quarter, with 7 companies driving the majority of the returns for the S&P 500 through the first 6 months of the year. A large driver of this outperformance is attributed to the ongoing developments within artificial intelligence that drove stocks such as NVIDIA higher. While markets did experience intermittent volatility following mixed economic data and concerns over the debt ceiling through the first 2 months of the quarter, stabilization in the banking sector, resolution of that debt ceiling crisis, and signs of cooling inflation helped propel markets higher in June, with the VIX falling to its lowest level since the pandemic. And although markets did see a sharp contrast in the performance of growth versus value through the first 6 months of the year, with the Russell 1000 Growth Index outperforming the Value Index by almost 24%, as shown on this slide, this gap did narrow in June, as markets started to see a potential broadening out of leadership. We'll touch on that a bit more in a few slides. Looking further down the market cap spectrum, while small cap equities have trailed the larger counterparts through much of 2023, strength in the biotechnology industry supported small cap equities to close the quarter. Now, building on the narrow market leadership theme we mentioned, this chart illustrates the strength of the so-called Magnificent Seven. Those companies are Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. The top line here shows the outperformance of these companies relative to the remainder of the companies in the S&P 500, with that much larger universe of large cap companies actually underperforming small cap equities, which are shown here by the Russell 2000 index. And that index in Russell 2000 actually was hampered in the first half of the year by the regional banking crisis we all remember. And also of note, following the outperformance of these 7 companies, large cap indices have become much more concentrated. And this is a dynamic that is best represented in the Russell 1000 Growth and the NASDAQ indices. Given the outperformance we showed on the previous slide, it likely won't come as a surprise that returns have been largely driven by 3 sectors through the first 6 months of the year, with those sectors being technology, communication services, and consumer discretionary. And as we discussed in June, you do see this dynamic start to shift as sectors such as industrials and materials also contributed to returns, but all sectors across the S&P 500 posted positive gains in the second quarter, sorry. At the risk of overstating the dynamics that drove returns through the first 6 months of the year, just 2 factors, growth and quality, contributed to returns. This narrowness largely holds true across metrics, as the most expensive stocks notably outperformed the cheaper stocks as well. Now, unfortunately, narrow market leadership did act as a headwind for active managers. Within large cap equities, active managers underperformed across the style spectrum, as they tend to be underweight these large constituents in the benchmarks. Within small cap equities, however, active managers fared a bit better, particularly small cap value managers who tend to be underweight regional banks, which benefited those active managers given the turmoil in the banking industry in the first half of the year. If we do see market leadership continue to broaden out to close the year, this may be a tailwind for active management. The S&P 500 has reported a decline in earnings for the past 2 quarters and is expected to again this quarter, so it may not be surprising that multiple expansion drove returns thus far in 2023. However, and a bit more optimistically, analysts expect positive earnings growth to end the year, which may support positive equity performance despite lingering macroeconomic uncertainties. So last year, we presented a chart showing the significant swings in the S&P 500 on the days of the CPI announcements, as economic data announcements were a key focus for investors in 2022. We updated this chart this quarter to show the more muted market response with CPI announcements this year. And while inflation data has been better, optimists may point to this as a possible indicator that a more normalized market environment may be a positive for equities to close the year. And looking at equity valuations, and similar to our tone on past webinars, small cap valuations remained attractive to end the quarter. Following the narrow market leadership of mega cap companies to begin 2023, certain segments of the market do appear more close to fairly valued, but small cap equities continue to trade below historical averages, with value more attractive relative to growth. And looking at the risks and opportunities, as Jessica mentioned, there is lingering macroeconomic uncertainty. And if we see any missteps or weakness in the consumer, there are risks to equity markets. And also, as Frank has said, bonds are back, and we have seen a continued narrowing of the equity risk premium, which may indicate that risk assets are a bit less attractive relative to recent history. But we are seeing more upbeat signals that may support positive returns to the remainder of the year, with estimated earnings growth a key component of this. But hopefully markets will also see a further broadening out of leadership. Being optimistic, positive returns through the end of the year are possible, although maybe not at the same levels we have seen for the first 6 months.
Catherine, for some of those indices, I'm thinking large cap growth and NASDAQ in particular. It's hard to envision a similar magnitude of returns for the second half of the year, but certainly positive returns on both indices for the last 6 months, I think is a very realistic expectation. I think a lot of this does hinge on earnings growth. And as a chart you showed earlier indicated, the first half of the year was really due to multiple movement as opposed to earnings growth. And what we really need to see is meaningful earnings growth to be a long-term support mechanism for equity prices. That's the picture on the U.S. equities. I think certainly more good news than bad news, not only for the first 6 months of the year, but as well as what the rest of the year looks like. And Evan, tell us about non-U.S. equities. Is it kind of a similar outlook? I know returns were good for the first 6 months, but do you see that continuing for the second half of the year? And what else do you want to share with us on the non-U.S. equity side?
Yeah, thanks, Greg. So sort of like you mentioned, we had another positive quarter for international stocks. As you can see in this chart here, the MSCI EFA index returned about 3% in dollar terms during the period, bringing its year-to-date figure to nearly 12%. Similar to 1Q, the EM benchmark was also positive, with a return of a little less than 1% in dollar terms for the quarter. But once again, it lagged the developed market index, in large part due to continued headwinds faced by Chinese equities, which we'll detail in a minute. China, as many of you probably are aware, makes up nearly a third of that benchmark. So to a large extent, as China goes, so does the broader EM space, which overall is up about 5% in dollar terms for the year. As you can see as well, non-U.S. currency performance was a slight headwind for U.S. investors during the quarter, although that dynamic has changed somewhat in recent weeks with the dollar kind of leveling off a little bit here, and we'll detail that topic as well later in the presentation. Information technology was once again the strongest performing sector of the ACWI ex-US index for the quarter, after notching a return of around 6% in 2Q. The year-to-date figure for that space is now upwards of 24%. IT has really been a juggernaut this year. A lot of that performance has been fueled by developments within the AI space, chip demand, which we've heard so much about, which Catherine detailed earlier. The non-U.S. financial space continues to chug right along despite a first quarter that saw the acquisition of Credit Suisse, as well as a couple of domestic regional bank failures. That sector was up nearly 5% during the second quarter. And then other value-oriented spaces like utilities and energy saw returns north of 3% as well during the period. So I would say somewhat of a mixed bag in terms of sector leadership for 2Q on the non-U.S. side. Style leadership was also somewhat mixed during the quarter. There's not a ton to talk about here. You can see that value and low volatility, those factors actually outperformed things like growth and quality slightly during the period. However, on a year-to-date basis, the non-U.S. market has been led by those kind of quality growth companies, which is the case on the domestic side as well. So of the countries that represent a larger portion of the non-U.S. market, Japan had one of the stronger quarters in terms of equity market performance. So Japanese stocks were up over 6% in 2Q, driven by some positive news on the macroeconomic front. So, for instance, Japan's economy grew faster than expected in 1Q at upwards of 2.5% annualized on a quarter-over-quarter basis. They've seen upticks in things like corporate investment, tourism, wage growth, et cetera. They've had an improving trade balance in recent time. And they've also seen some of the stickier components of their inflation approaching the BOJ's 2% target. So certainly some positive signs there. On the negative side, China was a laggard for the second straight quarter. That's seen country has seen a deceleration in economic activity in recent time, thanks in part to a Chinese consumer that's been categorized as cautious. China has also seen lower corporate profits, a relatively weak currency, and a slowdown in its real estate market recovery over the last few months. And while things like, government stimulus and accommodative monetary policy may be bright spots going forward, I think it's safe to say that a lot of investors are wary about this space at present. You'll also see from this chart that Euro area countries like France and Germany notched negative returns for the quarter. Some of that has to do with stubbornly high core inflation in the region, which we'll actually detail here on the next slide. So here we can see both headline and core inflation in the Euro area over the last year, so over the last 12 months. And the main difference between the two being that core inflation is more focused on the services side and excludes things like food and energy prices, typically the more volatile components of inflation from the calculation. And what you'll notice here is that while the headline number has moderated quite nicely within the last 12 months, the core figure has actually ticked up over that same time and now sits at around 5.5%. And that's weighed on equity market performance to a large extent. What does that mean for the go forward? Well, I think it's safe to say that ECB policymakers are likely to vote for another interest rate increase later this month, and then potentially again in September. And remember, we've already seen 2 negative quarters of GDP growth in the Euro area. So I would say additional monetary tightening could cause the region's economy to suffer even more in the near term. Non-U.S. currencies, as I mentioned earlier, were slightly negative for the period, both on the developed and the EM side. That said, 3Q could be shaping up to be a stronger quarter for international currencies. We're only a couple weeks into the period, obviously, but we've already seen the dollar kind of give up some ground against several major international currencies. So, for instance, the euro has strengthened in recent time. Continued hawkishness that I mentioned from the ECB would likely be supportive of that currency, which is still cheap on a purchasing power parity basis. The yen, which has been quite challenged, I would say, in recent months, has also strengthened since the end of 2Q. It's possible that the Bank of Japan will start to amend its yield curve control program in the coming months. That could lead to further strengthening of the yen. So, obviously not a particularly strong run for international currencies given the dominance of the dollar in recent time, but perhaps some reasons for optimism going forward. So currency could be an opportunity that the non-U.S. equity space currently offers. What are some others? We talked about Japan potentially being an area of interest. Another would be a subset, I would say, of the emerging market space. So countries like Brazil and Mexico. Frank talked about this a little bit during his comments, but a lot of these countries tighten monetary conditions quite sharply as early as the start of 2021, which means that they're now potentially in a position to cut rates in the coming months. These areas also stand to gain from a changing of supply chain dynamics. Mexico, for example, has seen an uptick in exports to the U.S., so much so that the gap in U.S. exports between Mexico and China has become negligible in recent times. So those are positives for that space. And then valuations. Jessica talked about sounding like a broken record. I sort of feel like a broken record when I mention this, but it's true. I mean, this has been a recurring theme. And obviously over the last 6 months, multiples have come up on an absolute basis, but relative to U.S. indices like the S&P 500, for example, pretty much every major international benchmark trades at a fairly steep discount across a variety of different price metrics. As far as the risks are concerned, I detailed the inflation picture for the Eurozone. That space may continue to face challenges as long as core inflation remains elevated and the central bank is forced into a more restrictive stance. The UK faces its own set of challenges. Inflation in that country is still over 8%, which means that you could see the UK economy tip into a recession as soon as year end, given the fact that the Bank of England is going to have to be very aggressive in raising rates. You also have a housing market in that country that's struggling mightily. So I think it's over a third of homes in the US the UK in the last 6 months have lost value. And that's a function of those higher interest rates kind of working their way through the through the mortgage market. And then Catherine talked about the narrowing equity risk premium on the U.S. side. The U.K. actually has negative equity risk premium. So the 10-year gilt yield is now higher than the dividend yield on the top 100 companies in the UK for the first time in over a decade. And that's typically not a great portent of strong stock returns. And then China, we talk about China pretty much every quarter. Sometimes it's a risk, sometimes it's an opportunity, sometimes it's both. These days, as I mentioned earlier, I think investors view the space as having more risks associated with it than opportunities. So, these are things to be thinking of as we're now in the second half of the year. And with that, Greg, I'll turn it back over to you.
Evan, I think one of the difficult things when it comes to kind of forecasting returns and expectations for non-U.S. equities is divergent trends and paths for countries. And today's discussion is a great example, right? Good news out of Japan, good news out of Mexico and some other emerging market countries, challenges in the UK, concerns around China, and then still elevated inflation in the EU, which probably leads to more rate increases and potentially even more difficult economic growth there. So a lot to monitor, a lot to look for, and certainly we will share those trends as they emerge in the coming 6 months. Now that wraps the traditional asset classes of fixed income, U.S. and non-U.S. equities, and we'll transition now to the alternatives portion of today's webinar. We'll lead it off with hedge funds. Chad, what can you share with us?
Great. Thanks, Greg. Let's start with performance here. Across indices, hedge funds were broadly positive in the second quarter. Really only one notable exception, and that's merger arb. The broad HFRI composite index was up 2.2% for the quarter, while equity hedge funds really led the way and continue to do so throughout the year, up 3% for the quarter, up 5.6% for the year. Catherine highlighted this earlier. I know Evan touched on it as well, but equity long short funds were boosted by some of the same themes in long-only markets. Gains in tech, really anything loosely associated with AI, and the outperformance of broader large cap growth names. While other strategies were actually benefited from the regional bank fears we saw subsiding and just overall volatility coming down. Macro strategies, though volatile, saw a rebound in the quarter, recovering most of the losses they saw in Q1, which if you recall was mostly driven by short positioning in US rates. As I mentioned, the only sub-strategy that was down for the quarter was merger arb, which has really been under pressure for two reasons. One, higher rates impacting financing costs, and two, elevated regulatory risks in M&A. I'll unpack this a little bit more as we go through it, but just notable there. What's more interesting, though, is if you look at event-driven, this actually includes merger arb as a sub-strategy. Those returns are actually much more consistent and positive throughout the quarter and also on a year-to-date basis, despite the struggles we saw in merger arb. So, if you look at the underlying sub-strategies outside of merger arb, you have mainly special situations and activist managers, and the performance there was more positive. So, I think if you look at that, this really highlights managers pivoting away from really pushing M&A across their portfolio companies, but still finding things to do in other ways to add value. So that's just something interesting to keep an eye on. If you go back to equity long short and look at leverage, we saw degrossing and short covering throughout the quarter, particularly in June, as managers were covering short positions with equity markets rallying. In aggregate, degrossing was largely offset by those gains, though, on the long side. So gross and net exposures were relatively unchanged over the quarter. If you look at the trading by sector, we saw hedge funds begin to moderate tilts away from some of those more crowded areas on the long side, namely mega cap tech, healthcare, staples. And then if you look at the short side, managers have been covering shorts on more cyclical sectors like discretionary, industrials, and even financials. So perhaps hedge funds are seeing reduced recession risk, I guess, to be determined on that, as we've talked about in other sections. What's interesting to note, though, is given the narrow nature of the U.S. equity rally this year, we talked about those magnificent 7 tech stocks. If you strip those away and look at just that 493 remaining positions in the S&P 500, equity long short funds have actually matched that return on a year-to-date basis, and they've done so with less risk, with less than 50% net exposure throughout the year, as you can see on the chart. So in other words, equity long shorts, though lagging the broader S&P 500, they're still really holding up well if you kind of strip out those 7 names and doing well this year compared to a more difficult 2022. Now, if you look at performance and dissect that a little bit further, we can look at crowded names on the long and short side. And crowded longs actually did a good job narrowing the gap versus crowded shorts for most of the quarter, but then gave that back up in June when shorts namely those high valued, overextended tech names. So for the last week of June, crowded shorts actually outperformed longs by about 300 basis points, and that counts for nearly all of the negative long short spread we've seen on a year-to-date basis. Turning to positioning and kind of stepping away from equity long short, we've seen hedge funds return to relentlessly shorting those short-dated treasury positions after that short reprieve we saw with the regional banking crisis in Q1. So if you recall, in Q1, bearish bets were punished pretty significantly when rates rallied on fears of that regional bank crisis, concerns the Fed could need to pivot and cut rates to relieve the pressure. But if you fast forward to today, the Fed didn't cut rates, will likely hike at least once more this year, and hedge funds are again emboldened with those positions on the short side and have really extended that out throughout this quarter. Now, we may see interest rates peak here, but hedge funds continue to show confidence that inflation remains above target and rates will remain higher for some time. So, I guess absent a recession, I think you're likely to see this posturing continue throughout the rest of this year. Now, if you turn to merger arb, which I alluded to in the beginning, we'll wrap up on additional comments here. You can see the lag on a year-to-date basis versus both fixed income, but really against the S&P 500. And that differential on a year-to-date basis is about 20%. So pretty remarkable. For the quarter, May was really challenging for merger arb strategies. The FTC sued to block, I should say, the deal between Amgen and Horizon Pharmaceuticals. And then right around the same time, TD terminated its deal to acquire First Horizon. So this caused concern across the merger arb space, spreads widen, and certainly impacted performance as a result. But if you take a step back, look at the bigger picture, merger arb has actually been under significant pressure for again, two reasons. Higher rates have made financing costs much more difficult to achieve, much more onerous at least. And then the second, probably most noteworthy reason here is that regulatory concerns are at the forefront due to actions from the U.S. FTC. Under Lena Khan's leadership, which she took control of the FTC in mid-2021, the FTC has significantly increased the hurdle it takes to get deals done, in particular for large M&A deals. So in some cases, they've gone to unprecedented lengths to challenge those deals and made it really challenging for companies to do business and acquire other companies and seek growth via acquisition. Now, it's clear the FTC's stance is to limit M&A activity as much as possible, though in reality, I think the end result you'll see is just significant delays on deals that would otherwise be approved with little ease under other administrations. So actually, to that point, since the end of the quarter, we saw a bit of a reversal. A judge ruled against the FTC's attempt to block Microsoft's deal for Activision Blizzard. Merger arb spreads have since tightened on that news. So we've seen a little bit of coming back down to reality on spreads. But as of this morning, that deal was also extended to October to allow more time for regulatory issues. So I guess we'll see how it goes. It's a pretty good litmus test for the rest of the merger arb space for M&A activity. And assuming that all goes through, I think that could embolden additional kind of pushback from the FTC's agenda here. That said, though, spreads are still elevated. There's still a lot of uncertainty in the space. And it's a reflection of the FTC's actions and the impact they're having on M&A. So for now, I think most hedge fund managers in the event-driven and merger arb space, I think they're just cautiously positioned. They're waiting a little bit longer to see that some deals get through some regulatory hurdles before they get in, and they have more time to take advantage of those attractive spreads as they move around. So I think it's still encouraging, but again, there's a lot of uncertainty there. So with that, I'll wrap up and turn it back to you, Greg.
Thanks, Chad. And I think the statistic you shared a couple slides prior about if you carved out the Magnificent Seven, compared the S&P 500 performance to equity long short, it really shows that long short funds are doing what's expected of them. And I think a bit more broadly, maybe again, carving out the merger arb sector of the hedge fund space, hedge funds by and large are doing what they're supposed to do. And that hasn't been the story as we've done these series over the last decade plus. So, all in all, I think hedge funds are delivering on expectations. So let's move now to real assets. And real assets consist of real estate and infrastructure. Historically, what we've tried to do on these webinar series is split that time pretty evenly. But what we're going to do this afternoon is devote a disproportionate amount of time to real estate and spend a bit less time on infrastructure. We'll tee up the conversation by looking at return data. And this is, of course, lagged data as well. We expect to get ought to see performance for second quarter sometime in the next 2 weeks. And trend-wise, it's going to mostly follow what we saw in the first quarter, which means that returns will be negative, really driven by further price drops. I want to point everyone's attention to kind of this middle section where we look at returns by property type and highlight really 3 sectors. First, the leaders of our industrial and apartment. And we'll see that will continue to be the case as we move forward here in 2023, as well as into 2024. Then the other one, which we'll spend some time on, is talking about office. And office really is what's weighing down the outlook for real estate more than anything else. And there's some further headwinds to the office sector, but also some bigger picture considerations, which I think mitigate the impact of office to overall real estate returns. But let's start first by looking kind of where we are from a price correction perspective relative to history. And what we want to do here is compare the price correction here, which we're seeing for the total index is 9% over the last quarter, over the last 3 quarters. So prices peaked in about the second quarter of 2022. For those of you looking at your computer screens, I'm really referencing the table on the bottom half of this page here. If you compare that to what happened in the GFC, clearly the correction was longer, but there was a 33% drop. And we're getting the question from clients, well, are we going to still see, are we going to see the same type of magnitude price drops as we saw during GFC? And we don't think so for a couple of reasons. Number one, the underlying financing of real estate holdings, right? It's like the bank situation. And in spite of the regional banking crisis back in March, by and large, banks are far more liquid and have better reserve ratios today than they did back in 2007, 2008. So that's reason number one. And then reason number two is that, again, if we carve office out of the conversation here for just a minute, the underlying fundamentals of real estate are actually pretty darn strong. We're going to talk about fundamentals, really 2 primary measures of fundamentals. The first one is vacancy rates. The second one is growth of net operating income, or NOI. We'll start with vacancy rates. And as you look at the chart here, if you look at that green line and then the lighter blue line, those represent the vacancy rates for industrial and multifamily. Again, those have been the leaders within the real estate space. And the fact that their vacancy rates here are the 2 lowest of the 4 sectors shown here, and really at or below long-term historical averages, again, shows the strong support for both of these sectors. And even retail has stabilized a bit. Now, of course, retail has had its fair share of issues over the last 5 or 6 years, but we've seen some stabilization in retail. But to touch upon industrial has really benefited from some new consumption trends, particularly e-commerce, which we've talked about on previous webinars. And then also just a rethinking of supply chain dynamics or supply chain initiatives, which we saw really kind of re-engineered and rethought after coming out of COVID. And then as it relates to multifamily, well, it's not no secret. Buying a house right now is really expensive. Not only are mortgage rates really high, but there's a very low supply of available houses for sale. Because of that, a lot of families are choosing not to purchase houses, instead rent. So these provide support for both industrial and multifamily. And then if we look at net operating income growth, it's really the same story, but packaged through the lens of NOI instead of vacancy rates. So the big takeaway here is that in spite of the negative headlines you see for real estate, we think that's a little bit overblown. However, like the 800-pound gorilla in the room as it relates to the outlook for real estate is office. There's a number of ways to frame this conversation. We're kind of going to look at it 2 different ways. Number one, just price, right? As demand has declined for office space, as shown here by a return to office trend survey. And this can be measured in a number of different ways. This is the way we're going to look at it here. But thinking through this for just a minute, there's just less demand for office space today. Companies have more employees working from home at least part of the week. We're seeing layoffs across a number of different industries right now, as well as more of an eye towards cost cutting. So because of all that, there's just less demand for office space. Now, office leases tend to be pretty long dated, typically written on a 10-year time frame. So we're not seeing the immediate impact of this less demand for office space right now, but it's coming. And then another factor which we're watching carefully is these loans coming due across different sectors. And by and large, as we sit here today, having gone through the regional banking crisis and recognizing that regional banks were an important source of financing for a lot of real estate deals, clearly it's more expensive today to refinance. But what we're watching most carefully is again those dynamics around office, because office, there's less demand, prices are falling, and because rates are higher and because there's less demand, you're seeing prices fall. So there may have to be an equity infusion to some of these real estate, to some of these office holdings. But again, this is really more concentrated in office than the rest of the sectors. The rest of the sectors, because of those underlying fundamental strength, we think that the coming maturities for industrial, for multifamily, and retail will not be as much of a headwind for the asset class as it is for office. Now, that's kind of the bad news and the concerns around the office sector. But we want to highlight a couple different things which we think will mitigate the impact of overall office price drops. First of all, if we look at the Odyssey Index, 10 years ago, office occupied about 37% of that index. Today, it's 21%. Clearly, some of that drop is due to just drops in prices and drops in absolute valuation levels of office relative to other sectors. But the other point worth making is that different funds, different real estate funds, hold varying degrees of office. Not surprisingly, the top quartile funds hold more industrial, which has been the leader, and less office. Closer to 20 or 19% for office, closer to 33, 34% for industrial. And then, of course, the flip side of that is the bottom quartile funds have more in office, which is around 29% probably on average, and less in industrial, which is 24%. And then the last point to make about office. So not only is it less of the index today than it was 10 years ago, but the expected performance of office properties, there's going to be a bifurcation of what those returns look like based upon the individual holdings. There are Class A trophy properties, which are still fully leased, even for office space, which will continue to perform well. It's just lower class properties, the Class B, the Class C, an overly large concentration of those within an individual fund's office holdings could be more of a drag on the overall asset class. We want to wrap here by taking a step back and looking at real estate on a long-term basis. If you look at this chart here, you see two leg down in prices since 1978. So around 1990, 1991, 92, and then of course the GFC, you saw large drops in prices. However, if you looked at the next 10 years, returns average more than 10% a year. So yes, right now, we'll probably see some more drops in prices. That will be a drag on performance. But real estate is an income-producing asset class. At least half of the returns, historical returns, has been due to income as opposed to price appreciation. And longer term, that's closer to 65%. The long term, we think real estate will continue to be a source of income, diversification, and inflation hedges, in spite of what happens to office properties over the next 12 to 24 months. If we spend just a minute talking about infrastructure, our thesis here really is similar and unchanged from what we've talked about in the past. Decarbonization efforts, zero emission efforts, supportive legislation from the Inflation Reduction Act in the Biden infrastructure bill will be long-term support mechanisms for the infrastructure asset class. If we want to talk about it from a valuation or a portfolio contribution perspective, infrastructure, similar to real estate, is more of an income play than a price appreciation play. What we've done here is compared the yield on infrastructure versus the yield on S&P 500. Admittedly, infrastructure does not have the same upside potential as stocks, but the meaningful yield, along with potential inflation hedges and portfolio diversification, really equates to infrastructure being an accretive addition to just about every portfolio with a long-term investment horizon. So that's real estate and infrastructure. Let's move now to private markets. We have private equity and private credit left to cover. Haley, take it away for private equity.
Great, thanks, Greg. So as a reminder, private equity performance is reported on a lagged basis. So the data displayed on this slide is as of Q1 2023. So as you can see, private equity and venture capital performance lagged public markets in Q1. U.S. private equity and global private equity were up about 1.7 and 1.6% compared to the Russell 3000, which was up 7.2%. So this was expected because it typically takes a few quarters for the private markets to be affected by public market volatility. Private equity and venture capital are still outperforming public markets on a long-term horizon. U.S. private equity deal activity has slowed in 2023 compared to the 2021 highs. Higher interest rates have made it difficult to find financing for deals, and this is what's causing the slowdown. But deal count is still ahead of pre-COVID levels. So this means that the deals that are getting done recently are smaller and typically easier to finance compared to larger mega buyout deals. So as you can see on the graph displayed, there's still a high level of dry powder in the market. majority of that dry powder is concentrated in the upper end of the market. That dry powder is going to need to be deployed. Private equity firms typically have a mandate on the time horizon that they can deploy their dry powder. So the dry powder in the upper end of the market has the potential to create exit opportunities for lower middle market private equity. Funds at the upper end of the market will be looking to use their dry powder to potentially buy companies at the lower end of the market. Due to credit conditions and a slow IPO market, private equity firms are holding on to assets for longer, causing a decline in exit activity. Exits in 2023 are down from their 2021 highs and are expected to lag until market conditions improve. Exit activity in Q2 this year lightly bounced back compared to Q1. There were 289 PE-backed companies that exited with a cumulative exit value of about $87 billion during Q2. So this is something that we're watching closely, and we're hoping to see exits pick up within the next year.
And Haley, to touch upon some of the comments from both Jessica and Frank earlier on in this afternoon's webinar, I think we've seen what happens to interest rates, and if we actually see a cut to interest rates in 2024, and seeing how that really shifts this landscape in terms of exit activity is a trend that bears watching as this year and next year play out within the private equity arena. So that's the equity side of things. Let's move now to the credit side of things. And Brett, you've been doing this for a while now, private credit. Tell us kind of what you see and what you're watching for.
Thanks, Greg. In reporting on a lag basis, private credit finished up 2.2% for the first quarter of 2023, lagging most public fixed income indices and equity indices, except for the Dow Jones Industrial Average. Alternatively, over the 1, 3, 5, and 10-year periods, private credit has bested all public fixed income indices while lagging the public market indices, as we would expect. Overall, the return and yield premium achieved by investing in private credit remains a driver and risk mitigant for the asset class. Inflation emerged as the top threat to investor portfolios the past year and a half, causing the Fed to raise interest rates quickly. The floating rate nature of these loans has benefited investors over the past year and a half, as investors have been protected as short-term interest rates have risen substantially. SOFR, which is the floating rate component of private credit, has risen nearly 500 basis points in the past 18 months alone. Additionally, credit spreads have widened on average around 100 basis points, providing private credit loans today with an all-in yield of over 10%, continuing to provide investors with strong income and a hedge against inflation. These floating rate loans are highly likely to outperform fixed rate bond allocations if rates were to continue to rise. While the increased yield on private credit is welcome to investors, it can come at the expense of the underlying company and its liquidity profile. The interest expense has undoubtedly caused significant impact on the bottom line for many businesses, leading to an increased default rate across all industries. That being said, the increasing default rate is coming off historical lows, which was caused by accommodative monetary and fiscal policy, and default rates are now more in line with historical averages, which is right around 3%. While the Fed rate hikes may potentially be coming to an end, default rates will continue to be top of mind for many investors, as higher for longer rates could potentially cause heightened default rates to persist into the future.
It'll take a little while for those default rates to actually show up in the returns. So that's another statistic for the asset class, which bears monitoring for the coming quarters. That is the conclusion of our prepared remarks. We're going to move on now to the Q&A session of the webinar. We have about 7 minutes or so. We've gotten some in advance, so we'll march through these, and then we'll take any others that come in before wrapping at the top of the hour. But let's start with U.S. equities. And Catherine, what might we expect from domestic equities to finish the year?
Yeah, I think we touched on this a bit earlier in the webinar, but I think a positive, although softer returns for domestic equity markets is absolutely plausible, but will require support from positive earnings growth, like we mentioned. I do think there are also some questions around the strength of the market outside of the Magnificent Seven. And while returns for that segment of the market aren't nearly as robust, they were positive in the first part of the year, as impacts on companies haven't been nearly as bad as many feared entering the year. And we also mentioned sort of small cap valuations, and we've talked about their attractiveness for a few quarters now. But on top of that, if you see a broadening out of market leadership, like we're started to see in June, any slight reallocation of assets away from those mega cap companies such as Apple would be a strong support for the small cap asset class, which could be positive. And with that said, though, there is also the negatives that we talked about in the volatility potential in the shorter term with a potential another interest rate hike, as well as the lingering consumer questions around the consumer. But I still think overall U.S. equity markets going to take a more optimistic tone and say they'll hopefully be a little bit more positive to end the year.
Thanks, Catherine. Evan, for non-U.S., why have Taiwanese stocks performed so well this year, given the poor performance of their Chinese counterparts?
So that has to do with the composition of the two different markets. So specifically the IT sector, which we mentioned has been a top performer this year, both domestically and abroad, is a huge percentage of the Taiwanese market. It's something like 70% of the MSCI Taiwan index. And not only that, but TSMC, so the semiconductor company, is something like 40% of that index. So one name is almost half the index. And that stock is up like 45% this year. And on the flip side, I believe the IT sector is something like 10% of the MSCI China index, maybe less than that. And so that's a major force behind that performance differential this year. And a good reminder that, just because China and Taiwan are close in proximity geographically and are mentioned in the same breath quite frequently, doesn't mean that the markets necessarily look the same.
Thank you. Hedge funds, Chad, is it concerning that equities have significantly outpaced equity long short funds year to date?
I think it's actually a good thing that we don't see equity long short funds chasing equity so far this year. For the most part, hedge funds have kept their gross and net exposures pretty consistent. So it's not a reflection that they're chasing at the moment, which I think would be more concerning. And I mentioned this earlier. I'd point out that the equity hedge funds are actually doing well to keep up with the broader U.S. equity indices this year. Once you strip out again those 7 tech stocks that have gone sort of parabolic here. So I think it's good to see some restraint here. I don't think you want them really stretching and getting too much equity beta in the portfolio at the moment. So performance may be a little more muted or maybe lagging equity so far this year. But again, they serve a different purpose. They're designed to drive alpha, and they're designed to provide downside protection when other parts of your portfolio aren't doing so well. And when those other parts of the portfolio are doing well, I think it's okay to have your hedge fund portfolio be a little more muted.
Frank, here's a question. I know some of our clients have asked about it. I'm sure I know you're getting the question too, as shown by this coming in ahead of time. What will cause a treasury curve to normalize?
Sure. So this has been a pretty popular question. I mean, normally when you see a treasury curve, your 2-year yields are sitting below your 10-year yields. That hasn't been the case for some time. So we've had 2 years above 10 years. So there's a few different ways that those could normalize. 2 years really driven by what goes on at the Fed. So this is what I would say is a plausible option, but probably not what's going to happen. Is the Fed holds, and then growth and inflation actually picks up, and you see the curve re-steepen by back-end rates moving. So that's one option. That's probably not what's going to happen. That's not what's happened really historically. What we've seen historically is when the Fed raises rates, they're doing so to fight inflation and slow down the economy, in which case they have done and not done it that well. They've actually probably done it too well and have driven the economy into a recession, in which case they come back and say, look, we've got to drop rates, where you see that 2-year rate then plummet, and now you're back to your normal curve relationship. So what I think will probably happen to normalize the curve is you see the economy get put into a recession, and then the Fed steps in and lowers rates, which drive front-end rates lower.
Brad, if the Fed were to continue to raise rates beyond current levels, how's private credit going to be impacted?
Yeah, it's a good question. It's not impossible, but it seems to be a low probability event at this point. I think across everyone's mind, or just the asset class, or the question you should be asking, are concerning interest coverage ratios. The areas of the market that we see having the most concern are healthcare related businesses that are heavily impacted by input labor costs or rising labor costs, specifically across that industry, but continues to affect all industries. Across the board, I'd say interest coverage ratios continue to be around 1.5 to 2 times. So still in healthy bands. What we have seen from managers is that, if interest rates were to continue to rise about north of 200 basis points or more, so anywhere close to 40 to 50% of where we are today, that would be the reason for concern, but there's still plenty of buffer between now and then. So hopefully we don't get to that point. But I think we're still in a healthy position. But those rising interest rates by another 200 basis points would cause interest coverage ratios to start to stress the overall private credit space.
Haley, last questions for you. How have fundraising numbers held up this year?
So 2023 has definitely been a difficult year for fundraising compared to 2021 and 2022, which hit record highs. So numbers are down about 20% this year.
All right, we are top of the hour. I want to make sure we're done on time, so I'll get back to your schedules. But I'll just finish by saying thank you to every one of you for joining us today. We hope this was a good use of your hour and helped clarify what happened during the first half of the year, as well as to what to expect and what to watch for across the different markets for the remainder of the year. Any additional questions, feel free to reach out to any individual analyst who spoke today. Their emails were listed at the page divider that started their sections, or more general questions could be sent to this email address right here, research5@marquetteassociates.com. Thank you all. Enjoy the rest of your day.